Hello, friends. How are you? Nice to see you back. Now we are going to start the another aspect of funds flow. Well, I already told you there are three steps. One is that a schedule of changes in working capital, which I already seen that. Introductory part of funds flow also we have seen that. Now the second step is funds from operations. We are going to see that also. And the third thing is funds flow, construction of funds flow statement, where long-term uses, long-term sources will be displayed and incorporated, and will arrive at the total movement of funds. Okay, and finally we will tell them how to read funds flow statement. These are all very important. So for academic purposes, you can follow me. The funds flow statement, actually, we start with funds flow statement. This is given the statement wise statement form, because all will not be very conversant with bookkeeping double entry. So I have given statement wise. We can put it also in the form of profit and loss adjustment account also. That if you want that also, I can work it out, no issues. But what are the things why funds flow? Because funds flow statement is the long term source. Net profit is a long-term source. Net loss is a use. Net loss is a use. So when funds is going out, okay, profit is a source. So this is the crux of the entire thing. So in that we have to find out the what are so you have to make some adjustments here. You have to make some adjustments here. So we to start with we'll have to first take the retained earnings or closing balance of P&L. Okay. So two balance sheets, two profit loss account is required now. So we have to start with the closing and end with the opening. So these are the two. The opening, closing, and then opening balance balance in the profit loss account. In that retained earnings, and the closing balance of profit loss account, we will have to add certain items to make some real fund. It is a real funds flow. The funds has really has moved out, and then we have to find out. So there are some items which where the cash is not involved. Cash is not involved, but still it is shown as an expenditure because the income tax allows this, accounting principle allows it that it can be a expenditure. So it can be tax deductible expenditure for which you can reduce your income. You can have some relief in income tax. Okay, that is also. Then it is necessity. So suppose machinery is going on continuously. That every year it is subject to some wear and tear. It will not be like that. It will be subject to some wear and tear. So it will be lose its value, its capacity to produce. So there is a diminishing in the value of the machinery. The first year it has some capacity, second year it is have a reduced capacity like that. So this is the depreciation we charge by way of expenditure, but it is a non-cash expenditure. For example, let us say, so wages is there, I am paying. Okay, wages I am paying. Repairs I am paying. Good. Funds is moving out. Then salary I am paying. Funds is moving out. You are giving a check. Bank account is reduced. Cash khazana is reduced. But when it comes to depreciation, do you pay anything? You don't pay anything. Your cash balance remains intact. Cash is not moving out, but it is shown as a expenditure and reduced from your net profit. So net profit is 10,000 rupees, let us say. After deducting depreciation, everything, net profit is 10,000. But it is shown as a 10,000 in the books of accounts, 10,000. But you go to the cash box or bank balance, it is 10,000, as of depreciation is 2,000, let us say. So 10,000 is showing as a net balance, net profit. Whereas you go to the bank and find out it is 12,000 because 2,000 though you have reduced it, but the funds is not affected. Funds is not affected. So to net profit, which is a long-term source of funds, for you have to make some adjustments. You got the point. So cash remains the same. So there are some non-cash expenditure, non-fund expenditure, which are deducted, which are reduced from the net profit as if you have, so some cash has gone out, you have reduced it, but literally cash has not moved out. There's no funds movement, so accordingly you have to add back. We have to add back. Likewise, in profit loss account, from the net profit, you have made some provisions, you have made some adjustments, transferring some amount to reserve contingency, and then like that you have debited, and then you reduce that net profit. But in the funds, as far as funds is concerned, it has not come down, so it has still remain the same. What you have to do, you have to add back. You got the point. So you have to add back. This is one side. The other side, there are some income which does not relate to the business. Supposing you have got your own property, you are getting some rent. So your rent received, you booked it in your official account. But thing is, it is related to your business. Supposing you are doing a cement bag, retail in cement bags. Okay, you are buying cement and selling cement. You put some amount in State Bank of India in shares. Some ICICI shares you are holding it. You received some dividend, 6,000, 10,000, etc. You are shown as an income, but it is not your income. It is not related to your core business. It is not related to your business, this family, this cement business. So what you have to do, you have to reduce it. You have added to your income. You added to your net profit as if it's a business profit, but it is not your business profit. It is not your business income. So what you have to do, you have to deduct it. So you have to detect it. Likewise, there was some entry you have made, some entry. Supposing last year, 2000, last year you made some provision for bad debts. Let us say some of the accounts have become bad. You have given some credit to cement bags to some customers. They are not paid back. So they thought it will not come back. So you made a provision from your profit. 10,000 rupees you made a provision last year. So this year audit has come with 10,000 is not required, 5,000 is sufficient because this is all coming back. Money is coming back. So your 5,000 again last time you have reduced from your profit. Now you are adding back to your profit. It's only book entry only. It will not affect your funds. It will not affect your funds. So some adjustments you have to make here and there. So you arrive at the what is the correct position from the funds from operation. This is the second step. The third step, we are going to work it out. We are going to tell the next sessions. So let us see. So now you got a point. Now you understood. Now I will just told very briefly. So, starting from the starting point, it is from the retained earnings, closing balance of profit loss account, and then here add non-fund, non-operating items. Non-operating, it is not related to your business. So depreciation. So depreciation is a non-cash item. Non-cash, I told you, no, money has not moved out from a Gajana, as from not from the bank. So you have to add back. To find the real funds from operation, you have to add back. Likewise, amortization of intangible assets. So this is intangible assets means it cannot be touched or feel. It is not tangible. You can't feel it, you can't touch it. But still you have got some value in the accounting eyes. Okay, let us see your name, your reputation, goodwill. So goodwill, you got some amount. So some 10 lakhs, the assessed as goodwill, 10 lakhs. Supposing while issuing the shares, from the face value, you are reduced instead of the face value is 10 rupees, you are issuing at 8 rupees. The 2 rupees is a discount. So discount, you make an adjustment in the book entry while issuing the shares. But thing is, it is not an asset, real asset. So what you have to do is, though it is shown as an asset, it cannot be written off over the same year, because same year you can't bear it. You can't bear it same year. So it is have to be paid over a period of time. So every year you are writing some amount from this intangible assets, goodwill. Suppose say 5 lakhs is there. Every year you are making a 50,000 as a write-off, 50,000, 50,000. Finally, it will come to an end. Okay, this is how, because it is showing it is not real asset. It's not a real asset. It is only accounting point of view. It's only it got its value, brand value. So you got some assets. So while arriving at the net worth, also you should not take into account this intangible assets, because no asset is existing. It is only assessment of your goodwill in the market, and accordingly you assess at 10 lakhs, 5 lakhs like that. So what you have to do is you have to reduce it from the profit. So you have to add back to find the real profit. Then appropriation started retained earnings. So some of the appropriation you are just transferring to general reserve, you are transferring to contingency reserve. These are all entries only. It has not affected your funds in any way. This is an entry from one account to another. That's all. It has not affected your funds. So you have to add back. This for this purpose only. This I'm adding it for this purpose only. Otherwise, it has got its own implications. This appropriation to retained earnings to general reserve, this depreciation reserve, etc., got its own purpose. That's a different thing, story altogether. But thing is, for the purpose of funds flow, the funds from operations, to arrive at the real funds from operations, you have to know what is the real fund. So you have to add back. For example, loss on sale of fixed assets. Loss is supposing 10,000 rupees is the return on value. Okay, as per the book, you have sold it for 8,000 rupees. 2,000 is a loss. It's a loss. But are you paying any cash? Take this loss on account. Are you paying? No, you're not paying. It is a loss, but it is not a funds is not involved in this. So you have to add back. So you got the point? You have to add back. So these are the things where loss on sale of excess. Dividend actually interim dividend. We have decided to pay. Interim they are paying interim dividend. So in this case, actually what happens is we are adding back in this funds flow from the operations because it is a funds from net profit is a long-term source. Okay, net profit is a long-term source. So while profit account they have been debited, debited interim dividend. But thing is, it is show it is we have to find out the funds from their true net profit. So you have to add back, and the dividend as you show you have to be you have to show as a long-term source because net profit is a long-term source. Dividend is dividend is paid out of net profit, so it is a long-term use. That is why you are adding back. So 10,000 is there. 5,000, let us say 10,000 net profit, funds from operations, 2,000 dividend paid. So 12,000 is the total funds from long-term source. So after 12,000, how much you are paying? 2,000 dividend. So it as a use of fund. That is why you are adding back. Dividend you are adding back. Got the point? Dividend you are adding back because dividend net profit is a long-term source. It is not a short-term like current assets, current liabilities. It is a long-term source. So, when the dividend, dividend we had already debited from your profit loss account, add back, you'll find the long-term source. Then show the interim dividend as use of funds from long-term source. So, long-term source is 12,000. Then use of funds, long-term use of funds is 2,000. What the point? From here to there. From here to there. What the point? So, that's why you are adding back. Okay, that's why you are adding back. Proposed dividend, if not taken as if currently, if it's proposed dividend is only provision. So provision, if it's not taken as current liabilities, if it's current liability, if it's taken as a current liability, you have to add in the schedule of changes. And finally it will come in the either increase or decrease. We have already seen that. So if it's not taken as current liability, you have to add back here. Okay. Then likewise, provision for taxation. If it's not taken as current liability, then you have to add it here. There are two times you can't add. So in this provision for taxation, if not taken as current liability, then you have to add back. When you pay the tax, takes to show as a long-term use. Okay. Then if you take including in the current liabilities, then the schedule of changes will take care of it. But if it's not taken as a current liability, you add to a net profit because it is shown, it is debited from the profit loss account. It is reduced from the net profit. So add back, and then whatever tax you have paid, you show it as a use. So you got the point. So you have to work it out. If there is no tax payment, only provision is made. If there is no tax payment, only provision is made for taxation. Show it in the current liability, then it will take care of its implications. If it's not there, you take it as a, if it's not included in current liability, you take it as a funds from operations. So either way you can do it. Take it as a current liability, it is taken care of. Okay, then it is got its own other, last time we worked out, schedule of changes in the working capital. There it is there, it will take care of its own course because no matter either use of funds, current assets, or source of current liabilities, it will be accordingly long-term source, long-term use will be taken care of in this. But in the case when you're not taken as current liability, you include it in the funds flow operations. In the case, the problem is if besides provision for taxation, if they say problem says tax has been paid so and so, then you have to work it out your provision for taxation account. You have to work it, open the account, credit debit you make it at, and what are the tax you have paid, you have to go as a long term use. Then the new provision you have made, you have to add back to this. That when you work it out, the entire funds flow will discuss. Time being, you remember this. If it's not taken in the current liability, you just add it here. Okay, likewise provision for taxes, if it's not taken current liability, you just add back. Okay, so any other item, not funded, not operating items, debited to profit loss account, you have to add back. So you are arriving some amount. Okay, you are arriving some amount. Then from there, I actually told you, reduce non-operating, non-fund item credit to profit account. So profit from sale of fixed assets. Supposing you are selling a table or you are selling an AC machine for a lesser value, you made some profit from your book value. Above on the book value, you make some profit. So it is taken as a profit. But thing is that will not related. That is not related to your business. So you have to deduct it from the. Supposing you received the dividend for your personal investments, you have taken it here, remove it. You received rent from your own premises, remove it from if you added. So you arrive at the true funds from operations. So it is very important, clear? So you got the point? So here again, excess provision you already told you. Supposing it's an entry, it is an entry made. So excess provision you are writing back, you are again crediting. There is no funds involved. So you have to reduce it. So any other non-operating items credited to profit loss account, you have to reduce it. So opening balance you have to add back here. You have to reduce it, all put together. Then finally arrive at the balance. This is called funds from operations. Funds from operations. So this is a simple thing. There is nothing to nothing difficult to understand. I hope you have understood from me. So I go. We will work it out on example also in the next session. Take care, but you find out while taking the funds flow, find out which is non-cash items, non-operating items. Accordingly, you add, deduct, and find the true position of the funds from the operations. The cement dealer who is dealing in cement, he cannot take income from his own house and take it as an income here because it is not related to his business. Okay, suppose he is selling the furniture, he made a book of profit. It is only non-operating income only. You cannot add to your income, so reduce it. So like that you can arrive at this. And next we will work it out on example also. I hope you have understood this. Thank you so much for your patience and listening. All the best. Thank you.